Now, starting point for most economic commentary anywhere around the planet at the moment has to be making some comments about Greece, about what's likely to happen over there, and the best way to sum that up is nobody has the foggiest idea about what is going to happen over there. The only thing we know at this point is that there's going to be another general election. It is likely that there will be some rogue government formed, dominated by the extreme left-wing parties. The great hope for a lot of people is going to be, well, let's forget about what's happening with that party. Let's see if we can get the 7% support down for the Nazi party. You see, this is what came out of the election of a couple of weeks ago, and the sort of thing I've been looking for on my 6 monthly trips over to Europe for the past couple of years. It's trying to find out at what point does the economic weakness become so great in Greece that society starts to fall apart and you get people voting for the electoral extremities, either the 7% going for this Nazi party or the 16.8% that's gone for this extreme, left-wing party, which the polls now are showing will likely garner 25 to 27% support in another election, because the bloke there running it is sort of young, sort of personable, and he's saying no more austerity, like people think that if they vote for him and he gets his way, everything's going to be smoothed out and they can somehow remain in the euro. Well, this is just not going to happen. The Germans will not let this happen, shall we say, in terms of, you can stay in the euro and back off on your fiscal austerity. She'll be right, and yes, we're going to greatly boost our wages and run down our own fiscal surplus, give you or increase the deficit to help you out down there. This will not happen. There will be some minor backing away in the Germans from their fiscal austerity. Angela Merkel will give something to the new French president, Mr. Hollande, for instance, in terms of a growth package. But the thing to note here is that Europe has had various versions of growth packages for decades now, increasing activity of governments in their economies. And if that was really going to be driving yourself forward to some great shiny future, they would not be in the state that they are in now. And when one says the state that they are in, when you're looking at any individual economy over there, it's sort of different from the other economies in terms of what it is that's stuffing them up. One economy may be munted because the banking sector is overly lent to the property sector, for instance. Another economy is munted maybe because the government debt is excessively high. And if you look at a country, say, such as Spain, it went into the global financial crisis with the government accounts in relatively good shape. But what's hit them has been massive over-construction of houses, of apartments along the coast, etc. Maybe a 1 million apartment oversupply in Spain, for instance, and apartment prices which so far have only fallen by about 25%, not the deep correction 34% on average in the United States, for instance. And the view in Spain is that there's a lot more downward correction to come in their prices. And in France as well, their house prices have actually been rising in recent times, and the feeling is that's definitely a false dawn, and their apartment prices, etc., are going to be falling away in the very near future. And what you've got is different versions of sort of four things for these economies apart from the likes of Germany. Number one, you've either got your government accounts sort of blown out in terms of a very large fiscal deficit, 6-10% the size of your economy, and or a large level of debt, 80-100% of GDP. So maybe it's your government accounts that are munted. Maybe it's the excess supply of houses, and so just loss of people's wealth as the prices have fallen, etc. Maybe it's the banks who have already taken big losses on their exposure to the residential property sector. Maybe it's your economic structure, the fact that in Portugal you can't sack half the people, the fact that about 80% of Portuguese workers have never completed high school, essentially. Or in Spain, where up until just recently you had to give, for each year a person worked and you laid them off, you had to pay them 44 days redundancy. This sort of thing. Just extremely rigid economies. And Germany, you see, the Germans have spent the past 10 years, or what have we got, past 20 years or so, absorbing East Germany, and the past 10 years in particular, improving their labour market, the smooth functioning of it, and reducing their unit labour costs per unit of output, at the same time as the likes of Greece and Spain and Portugal have been busily increasing their cost of production. So the difference between the productivity levels in Germany and these other southern economies in particular is just huge, and there's simply no way that you can put in place a good strong fiscal austerity package aimed at getting government accounts back in order and reasonably have that gap of your economy's productivity with the likes of Germany shrink in a small period of time. And it's fairly clear that we've reached the point over in Europe where the austerity is starting to break the society apart, predominantly down there in Greece, but also, we can see elements of it across in Spain, etc. Which meant that when I was in Madrid a couple of weeks ago, and I was there unfortunately for the May Day holiday, it was closed. And then the Wednesday, the day after, Madrid itself was closed because they were celebrating some 200 years ago. Maybe they quit fighting with the French or something like that. And as I'm walking around in the late morning in the centre of the city there, and I see all these police everywhere with their guns, and as a Kiwi, one always finds that relatively shocking. And then I see a few mounted police, and then I see some barriers, and then I see these large white trucks with policia on the outside there, sort of turning into this road, and I'm thinking to myself, there's going to be a riot. This is the day after May Day or this sort of thing. They're going to have themselves a good old riot. I'm going to stick around. And so I got my camera ready, basically. And so I'm standing there, and then I start walking along a bit, and I come across this grandstand of people, and I think, oh, this is well organised. They're having an organised riot in Madrid as well. And then I keep walking a bit around the corner, and I see these lovely lined up ranks of police on the scooters, on the motorbikes and little cars, etc. It is, some sort of a parade. And so I was aggressively mistaken in terms of, my expectation of a riot, given the economic conditions, not only about the people, but even about these big white trucks, which I thought the rioters were going to be put into, the black Mariahs, the white Mariahs in this case. No, the trucks had these lovely white performing horses in them in the main square there, dancing around and doing their thing. So, I was slightly disappointed, basically. I haven't seen a decent sort of riot since the Springbok tour, as it were, so no photos in the weekly overview from Spain. But there will be some backing away on the fiscal austerity side. Whether they back away, whether they don't. Whether they back away a lot on fiscal austerity and have some sort of growth stimulus package, none of it really matters. Because if you do get a bit of an easing off in the short term, governments raise taxes, cut spending, all you're doing is buying a bit more time over which the reforms will spread out, etc. And so instead of maybe you go through absolute hell for a short period of time and then you bump out with good growth 5 years down the track, you're stretching the whole thing over to 7, 8, 10, 20 years or so. And this is a key point I made in terms of governments and the actions that were taken to stop the Great Depression scenario of late 08, early 09, that you do whatever it takes to stop that Great Depression ball rolling, the whole deflationary thing, in late 08. And so governments cut taxes, increase spending, fully recognising that you then pay the price for that, blowing out the deficits over the next, and I remember saying it at the time, over the next maybe 20 years. And that's the sort of scenario I think that we're looking at in Europe, that whatever they do in the near future, growth will be low and slow over there. Now, when we get the election, it's likely we'll get this party rejecting further austerity measures in Greece, and they will probably be booted out of the euro. And that's, of course, what scares the bejeebers out of everybody, because you think, okay, if they hop out and somehow they think it's a good idea, maybe the Portuguese will think about doing it, and maybe one of the more serious economies like Spain or Italy will think about doing it. Extremely unlikely. But that contagion effect, you see, is just calling into question very strongly right now the viability of the euro. And what people are starting to pick up is that there's maybe more than just speculative, I'll hop out of the euro for a while and sit in another currency flows, that there's more long-term investment going out of the euro into anything else, because nobody exactly knows what's going to happen there. And in terms of Greece, if they hop out, the feeling is, okay, they convert to drachma. There's no drachma printed, as it were, so as they say, you just have to stamp all the euros, close off the borders, and whatever euros people have got in there, search every car, every horse, whatever going out there, and so you turn their euros into drachmas, and as soon as the currency floats, it immediately falls about 75%, is the expectation. And so here you are an entity in Greece, household, business, government, bank or whatever, you will have debt obligations in euros. Your partners to which you owe this will not be willing to accept shitty drachmas in exchange for it. And so you simply will not be able to repay your debt. And the estimate is out there that you could be looking at losses for outside entities, outside of Greece, of maybe 500 billion euro. €500 billion. Now, that's a bit of severe economic damage. It would wipe out the capital base of the European Central Bank, for instance. The other members, the 16 remaining of the euro, would have to contribute new capital towards the ECB, for instance. So this would be exceedingly messy. And the thing about things being messy, of course, is it hits sentiment. It hits confidence. And so businesses pull back from investing, from hiring, consumers pull back from buying stuff, and you get investors pulling away from risky assets, like the Kiwi dollar. And so the Kiwi dollar has fallen away from 82 US cents a few weeks ago to 76.5 at the moment. And given the Greek election, etc., coming up, the risk is we go lower towards 73, maybe 74 in the very near future, and lose a bit of ground against a weakening itself a euro, and maybe we fall towards 45 pence or something like that. But the key thing to note here is that while this will be economically damaging, it gives a relatively weak outlook for the world economy, there will be some sort of poultice applied to this current crisis. There will be some things done which lead the markets to conclude maybe in 2 or 3 months' time it's settled down for now. I think they think it's settled down. Therefore, it's settled down. And so things will go calm, the share markets will recover a bit, and the Kiwi dollar will probably go back up to some degree as well. And we may see some recovery in commodity prices. And then people will think it's over. And then we'll go through another version of this 6, 9, 12, 15 months down the track, possibly each of those timeframes. This will continue on for some time.